what the Rockefellers do, talked about strategies that you can use to use life insurance, like participating investment grade life insurance, to be your own bank, and have it so that. Well, why don't you just give the pitch for what would the Rockefellers do about the story of how they survived and the other rich people didn't?
Well, imagine like right now, we're seeing major downturn in the market. What if someone were to pass away that's a major breadwinner in a family? Well, their entire kind of portfolio suffered, and it's very heavily reliant upon assets outside of maybe the family's understanding once it's passed on. Where if we're using death benefit, that helps us during downturns. It builds in contingency plans. It builds in buoyancy. And the people that have the type of insurance I'm talking about have had zero losses right now. They're already locked in on their dividends from last year and a minimum guaranteed interest rate this year, typically of around 4%. So even though that's not an exciting rate of return, it has a lot of tax advantages, and you can tap into it before 59.5. So while everything is down and depressed and there's distressed people, you might be able to pick something up at a major discount. When I say that, I don't really believe the major discount exists in the public markets right now. I think the major discounts exist in the private markets. People that are buying, privately held businesses that didn't manage cash flow very, very well, or don't have the bandwidth or the wherewithal to kind of weather these storms. And so, when you have access to cash, there's major opportunities. And I like that none of my cash is going down in the market. The only place my cash is going down right now is in the devaluation of the dollar. Right now, we're just going to flood and put more money on computer screens, and or print it, or if we even do that anymore.
Yeah, so, you're gonna get $2,000 a month from the government, but your purchasing power of what that can buy is gonna just erode over time.
So check this out, because this is something that people really hammered me on last year on YouTube. I put out this video saying paying off your mortgage will destroy your finances. And look, that's like it's not clickbait, but it is sensationalized headlines to grab attention. But let's say everybody starts getting their $2,000 a month. Well, if everybody's getting this check of $2,000 a month, those people that have fully mortgaged their properties feel less pain in that than the people who used all the money that was worth more previous to this to pay it off to watch the dollar devalue. Because when we devalue things, debt actually becomes cheaper. When we pay cash for it as it's devalued, because we used it when the cash was worth more, it's actually more painful. And my bigger issue on that entire video was saying, look, if you're paying extra, you're creating equity jail. You're creating a situation where you've got equity in a property because of the money you paid into it, but it doesn't lower your payment, it just shortens the term. And if you don't get to the other side of that term because COVID-19 and you're a restaurant or a chiropractor or something where you cannot operate your business right now, the bank isn't going to lend you money, and you've locked your liquidity up in a place that's really dangerous, because the more equity you have, the more susceptible you are for foreclosure, because the bank wants, they want the property with the most equity in it, not the person that has no equity in it, and they have no gain if they actually foreclose on that.
Okay, hold on. Say that again, because I kind of lost you there. So the bank will want to go after, let's say, in the situation where banks start to get in trouble and there's credit crunches and all that, they're going to go after what first?
Well, think about it. If you have no equity in your home and you stop making your payment.
So if your mortgage is like maxed out 80% LTV or whatever.
They have such little incentive to take that property because that's called REO. They're not good at turning around and selling that. It's it's not a good loan on their books. But if on the other hand, someone only owes $50,000 on a $250,000 property, but now is illiquid, now their cash flow dries up. The bank is incentivized to get that property because they could turn around and get their money back and be free and clear of that. So
but if you've paid your mortgage off, you don't have to worry. Yeah. But if you still have, that's kind of counterintuitive, but yeah, that makes sense. That if you've got any loan at all and you get into financial hardship and you can't pay your bills, they're going to go after the lowest hanging fruit for what they can then flip and sell and get, return.
So either be fully paid off or fully leveraged.
Right.
Your keys.
I saw I listened to a podcast today from Real Vision. You ever listen to those guys?
I haven't. No.
They're really good. You should put them on when you're getting your hair cut.
Yeah, so that's why
you'll never listen. So Real Vision, they said they had someone on today who was like a banking expert or something, and he was saying that banks have the ability for business owners who have both their debt and their assets with the same bank. Banks can actually bail in and just take the assets to cover the debt if they feel like businesses are going to start to fail and people are going to get in trouble. So he was suggesting that if you've got debt with a bank, you should take your bank accounts and put them to another bank before that scenario happens, because then they can't just reach across the other bank and take your assets to cover your debts.
Depends on your contract and what your contract says is part of that. But the other issue that a lot of people are going to be facing is a lot of people have created lines of credit to protect themselves, right? They've got an equity line of credit on their home, or they've got a business line of credit they could tap into when they're having cash flow issues. But we've already seen in the last few weeks, a lot of major corporations and people have dove in to find that cash and pulled it out because they're not sure if they're going to need it. And the reality is, if you don't do that, the bank could start saying, you know what, you're not using this line of credit. We're just going to eliminate it.
Right.
We're going to cut it down. And so that's a real danger for people if they're relying on their lines of credit for liquidity. You know, it's nice to have them, but you're not going to be guaranteed to have them. When we saw in 2008, I just had so many clients where the banks just eliminated their line of credit. Yeah.
Mike was saying there that it's not in Canada. I think he was referring to the thing that I said. How the banks can't just take your money. But also what you were just talking about credit there. I was advising people yesterday or the other day on my Facebook that if you've got any ability to take equity in your house, if you say you're at 50% loan to value or something like that, just take the cash now so that you can use it to buy distressed assets in 3 or 6 months or something like that. You still advocate people do things like that?
Yeah, I mean, I think you got to be really calculated and careful. So the big question I have is, are you an investor? Because I see a lot of people right now that are buying stocks because they think those stocks are low.
Right.
But I mean, the stock market is a pretty volatile game that they don't know enough about, because they're going, well, cruise lines, those are going to come back. So right now they're a deep discount, or airlines, that's at a deep discount. But I mean, I would be really careful with that. On the other hand, just had one of my guys that works at Wealth Factory buy a business last week, and he's going to cash flow it from day one. It actually can do really well during these times because the type of business it is. And, you know, when you're buying a business that's $1 million of revenue or less, usually don't see these major multiples like you see with public companies. Like if we look at $1 of profit versus the purchase price in a public company, that has been a really, really high purchase price per dollar profit. Or if we look at the PE, right?
So you're talking about the multiple, right? Like a business that's a private business. If you were going to invest in a local business, you're not going to pay 20x what they're making. Right. But
no, you could get it you could get it for less than 1 year's revenue. You can get it
especially in hard times, right?
Right. A fractional multiple being under 1 time. So
like I was looking at Boeing, just for the example that you just mentioned about trying to buy things cheap. I'm not really a stock picker guy, but like I'm a FOMO sapien. So when I see things are like look low price, I'm like, I gotta get some of that, you know? So when I saw Boeing went from $350 or something down to like 90 or whatever it was at, I was like thinking, okay, I'm not into stocks, but maybe I should buy some of this. And then I went and looked into it, and even at that bottom of like $90, it's still like 20x their profits.
Yeah.
So it's still extremely overvalued. I just don't understand how this
fundamentally a week ago saying the stock market's still highly overvalued, and here's why. And it's not getting nearly the views it deserves. It's a great article, and I get that I wrote it, but so it might sound a little bit arrogant, but the reality is I think it's really accurate, and it really could help people navigate this, because we act upon emotions when we see this level of volatility, right? And it really triggers the fear versus greed emotions. And, so you see both extremes right now, but I'd be highly skeptical for people to go pull out all their equity to buy real estate if they've never done real estate before, or pull out a bunch of equity to go buy a stock if that's not their expertise, because you're going up against hedge fund managers with analysts that are some of the most brilliant minds in the world, and somehow think that you're going to outsmart it. I would be very, very careful with that, because in 2000, we had a 3-year downturn in the stock market, double-digit losses for 3 years in a row. from 2008 to 2010, same situation. I've been calling since 2018, 2019. I got really vocal about it in October, that 2020 was a year that we were going to experience a recession. And if we didn't by the end of the year, I was retiring from this game, because it was highly built upon leverage. It was built upon people borrowing. And we saw 7.6 million people behind their car payments 90 days back in February of 2019. All the indicators were there. And we kept tinkering with it with the Fed. We kept tinkering with it with, infusions of capital and all these kind of things. But eventually, the dam breaks. Now, COVID-19 made that a massive break. And I had no clue anything like that would happen. It's not where it was on my screen whatsoever. So now it's happened even faster. But I really thought this was going to be a 3-year process. I now don't know what to say with everything we're dealing with a social distancing, quarantine, that kind of thing. It really adds a whole level of complexity.
Yeah, it's like there was going to be a pop for sure. And the coronavirus was just the pin that came along. It could have been anything. Like, it could have actually been the oil war between Saudi Arabia and Russia that popped everything. But it just so happened they both hit at the same time.
Yeah, these are really heavy straws on the camel's back, right? These are lead straws. They're not fat.
Yeah, these things have been in the stock market and in the markets. There's been excess risk in the market since 2008. Still, a lot of people thought that we never bottomed in 2008, and the central banks coming in and the Federal Reserve printing trillions of dollars coming in just kind of like made it so that the risk couldn't purge. So you get the benefits of the risk. The 10% of the people get the benefits, like you mentioned, like the CEOs and the insiders and the elite bankers and stuff. They get the benefits of the bailouts and everything. But, now we have this on steroids. This is like central banks are going to print $6 trillion this year, at least.